What is going on, traders? And welcome back to the channel. This is Explain the Charts. Today is October 1st, 2025, and we are taking an in-depth look at USDCAD, the US dollar versus the Canadian dollar. This pair is at a fascinating crossroads, with conflicting fundamental signals and a very clear technical picture developing. First, let's cover the news, because there is a lot to unpack right now. Headlines show the pair is consolidating above the key 1.3900 level, largely driven by lower oil prices, which typically weakens the commodity-linked Canadian dollar. Interestingly, we're seeing widespread US dollar weakness against other majors like the Aussie and the Euro due to the recently announced US federal government shutdown. However, USDCAD is holding firm, suggesting the Canadian dollar's own weakness is currently the more dominant factor. A major piece of this puzzle is central bank policy divergence. The Bank of Canada recently cut its key policy rate on September 17th, signaling a more aggressive easing stance compared to the U.S. Federal Reserve. This monetary policy differential is fundamentally bullish for USDCAD, as a weaker Canadian interest rate makes the US dollar more attractive. While some analysts have set year-end targets as low as 1.33, others are looking at a potential ceiling much higher, near 1.44, so expert opinion is currently divided on the long-term path. Now, let's bring up the daily chart to see how this has played out. Looking at the bigger picture, we can see a very strong and clear uptrend that began back in the summer of 2024, taking the pair from lows near 1.34. The price action has been characterized by steady advances, followed by periods of consolidation. We saw a significant peak formed back in December of 2024, right around the 1.446 level, which is a major long-term resistance area to keep in mind. Since then, after a sharp correction, the price has been grinding its way back up. The current consolidation is happening just below the psychological 1.40 barrier, which is a common area for price to pause and build energy. Let's zoom in on the last month of price action to see the effect of that Bank of Canada rate cut. As you can see, on September 17th, the day of the announcement, we saw a firm push to the upside, confirming the market's bullish reaction to a more dovish BC. That move helped establish the current support zone we are trading in. The key support level to watch on this daily time frame is around the 1.38 mark, which has held on multiple pullbacks in September. Below that, 1.37 stands as a more significant structural support level. To the upside, the recent highs around 1.396 are the first hurdle for bulls to clear. Now, let's switch over to the 1-hour chart to get a feel for the recent intraday price action. While this data is from a couple of weeks ago, it perfectly illustrates the character of this market within the broader uptrend. We can see that even as the daily trend moves higher, the intraday action can be choppy and range-bound for extended periods. This highlights the importance of being patient and waiting for clear breaks of structure rather than getting caught up in the noise. We can observe periods of sharp decline followed by grinding recoveries, typical of a market that is consolidating its gains before the next leg up. For day traders, this means being selective is key, focusing on trades near the edges of these smaller ranges. Drilling down even further, let's look at the 15-minute chart from the last few days. This time frame perfectly reflects the news we discussed earlier about the pair trading in a sideways pattern. We can clearly see a well-defined range has formed. The ceiling of this range, or short-term resistance, is right around the 1.394 level. The floor, or short-term support, is holding firm near 1.391. This is a classic consolidation pattern where buyers and sellers are in a temporary equilibrium. The price is coiling like a spring, and a breakout from this tight range is imminent. A sustained break above 1.394 would be a bullish signal for short-term traders, targeting the higher resistance levels we identified on the daily chart. Conversely, a failure to hold 1.391 could see the price quickly drop to test that next major support level around 1.38. Okay, let's switch back to the daily chart to put it all together and recap. We have a strong fundamental reason to be bullish, which is the diverging interest rate policy between the US and Canada. We also have a strong technical reason to be bullish, which is the clear long-term uptrend. However, the price is currently consolidating in a tight range and is approaching significant psychological and technical resistance. So, let's recap the key price levels to watch. Immediate resistance is the top of the short-term range at 1.394, followed by the September high around 1.396. A decisive break above 1.40 would open the door for a much larger move, with the long-term target being that 1.44 resistance zone. To the downside, immediate support is at 1.391, but the more critical level is the daily support at 1.380. A break below 1.380 would be the first major sign of weakness and could signal a deeper correction towards 1.370. So, what's my take? The bullish scenario seems more probable. I'd give it about a 70% chance, given the strong fundamental and technical alignment. This would be reinforced by continued weakness in oil prices and a break above the 1.40 level. The bearish scenario, with a 30% probability, would likely require a significant event, such as a sharp rebound in oil prices or a severe downturn in the U.S. economy stemming from the government shutdown, leading to a break below 1.38. Keep an eye on upcoming employment and inflation reports from both countries, as well as any commentary from the Fed and the Bank of Canada. And that's our deep dive on USDCAD. Remember, this is not financial advice, and you should always conduct your own research before making any investment decisions. Thanks for watching Explain the Charts, and we'll see you in the next one.